Right, good morning everybody. Welcome to our second webinar for 2017, and in this webinar we focus on not-for-profit entities. Now, not-for-profit entities often feel a little bit neglected because everybody talk about for-profit, talk about private sector, therefore a very specific webinar just for our not-for-profit clients and not-for-profit entities. Now, there's big things happening for not-for-profits. In December, the Australian Accounting Standards Board issued a brand new standard, AASB 1058, addressing income of not-for-profit entities. Therefore, in today's webinar, we'll focus on that. Exciting times if you're in a not-for-profit, absolutely. So the outline of this session, we focus on income recognition by not-for-profit entities, but I've divided the presentation really in four sections. We'll start off by looking at the new AASB 15, revenue from contracts with customers, which initially has been developed by the International Accounting Standards Board, the Australian Accounting Standards Board, for-profit private sector entities. However, in December, the AASB have issued amendments to AASB 15, which is discussing the application of AASB 15 in a not-for-profit environment or not-for-profit industry. So a huge development, and one should compliment the AASB for the work they've done in that space. Then the second section, we look at when does AASB 15 apply to not-for-profit entities. So does it automatically apply to not-for-profit entities? We've got a few hurdles to jump. We'll discuss that. Thirdly, we look at when does AASB 1058 apply to not-for-profit entities. And then if AASB 1058 applies, what are the requirements of AASB 1058? That's our last section. So that's a bit of an outline of what we'll be doing today. So the current not-for-profit income recognition standards, the first question you'll ask, is the entity a not-for-profit entity? And if you say yes, your second question currently would be, did the entity receive a non-reciprocal transfer? And there's a lot of debate on when would a transfer be reciprocal, non-reciprocal, but it's a very important question in the current environment, because if you say yes, we've received a non-reciprocal transfer, you have to apply AASB 1004 contributions, and that standard in itself has very many issues, and the biggest I would say is when do we have control of the transfer of the asset, and there's a lot of divergence in practice around that. If a not-for-profit entity did not receive a non-reciprocal transfer, therefore it was a reciprocal transfer, you would apply, a not-for-profit entity would apply normal accounting standards for revenue recognition, AASB 118 and AASB 111. I think the other thing to note, very important, is that not-for-profit entities can never apply AASB 120 around government grants and government assistance. That standard is solely for for-profit entities. So please stay away from that standard. So currently, this is our decision tree. These are the decisions we have to make. It's led to a lot of divergence, a lot of arguments, a lot of discussions, and finally we've got a standard or a suite of standards that replace this and really takes us forward in addressing how would not-for-profit entities recognize income. So the new not-for-profit standards ultimately would only be two standards. It will only be AASB 15, and then it would also be AASB 1058. However, in the interim, we've got three standards, and I'll have to explain that. In the interim, we've got that middle standard, AASB 2016 number 8, Australian Implementation Guidance for Not-for-Profit Entities. Now, why would I say in the interim we have that third standard? The AASB have issued AASB 15 a few years ago, and then in December they've issued this amending standard, the Australian implementation guidance. And then when they have time, usually once every 6 months, once every year, they go through a process of integrating the original standard with the amending standard. Now that hasn't happened yet. So if you open AASB 15, there won't be Australian implementation guidance because AASB 2016 number 8 has not been integrated or embedded in AASB 15 yet. It's an admin process that will take a bit of time. So at the moment we've got 3 separate standards that you have to read and consult, but in I would say 6 months, 12 months time it would only be 2, AASB 15 and AASB 1058. I've had a few people email me and say, Aletta, you talk about certain things, I can't find it in AASB 15. It's because it's still in that separate amending standard. On the slide, I've also provided you with the effective dates of these 3 standards, and the effective dates are all the same, one for years beginning on or after 1 January 2019. Therefore, I know most not-for-profits have a 31 December year end, and therefore the first year end that you would apply these standards would be 31 December 2019. If you've got a June year end, it would be 30 June 2020. Now you would look at that and say, Aletta, why are we talking about this today? I thought it would be good to look at a timeline. And let's say we've got a 31 December year end. It means 31 December 2019, that would be our current year. Our comparative year would be 31 December 2018, remembering that these standards will be applied retrospectively. So your current year 2019, your comparative year 31 December 2018, the start of your comparative year is 1 January 2018, and today we're actually on the 1st of March. I'm sorry, I'm a little bit late. February, March, we're at the beginning. So we've got 10 months to get ready for the beginning of the comparative year. If you've got a 30 June year end, you've got another 6 months. It's really important that we start to think about this, think about our processes, think about our disclosures, think about our funding. It impacts our budgeting. So that's why we discuss it today already. So I thought in section 1, let's start with the new AASB 15. And if you're not fully aware of the details of AASB 15, we will be hosting a number of webinars on AASB 15 during 2017, so you can register for those. In certain situations, not-for-profit entities will be applying AASB 15, therefore it would be important to understand the detailed requirements of AASB 15. Today I just want to give you a very brief, very quick overview before we look at when this will be available to you. So AASB 15 talks about the core principle that we've got is that revenue would be recognized to depict the transfer of promised goods and services. So promised goods and services would be performance obligations. So we recognize revenue to depict the transfer of promised goods and services to our customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. So expectation is a big thing in the new AASB 15. Therefore, if I sell something to a customer for $100 and I say I'll give you a settlement discount of $10 if you pay within 30 days, if I expect, and based on past experience, I know that customer will settle within 30 days, then my revenue when I deliver the goods is actually the 90, the amount I expect to receive, and not the invoice price of 100. So expectation is very important. What amount do I expect to receive? Now, to build up an expectation, we usually need past experience. So that's why it's important to get ready early on, because sometimes I need past experience and I want to start to gather that information to influence. Now, how would we apply those, or how would we apply that core principle? There are 5 steps. Therefore, going forward for our clients, we would expect to see an accounting policy that would have the core principle, that would have the 5 steps, and how we've applied these 5 steps to each and every revenue stream. So for not-for-profits, you could have different revenue streams. You could get government funding or government grants. How would you recognize income from those? You could have a different revenue stream where maybe you provide a service at a price. You could sell goods. There could be different streams, different funding streams, and you would recognize income potentially differently for different funding arrangements. And we have to apply these steps if you are within AASB 15. So let's look at a basic example to give you an idea the gist of AASB 15. Now this is a for-profit example, but it's to illustrate a principle, and we'll do a number of examples for not-for-profits a bit later. So first of all, step 1 is to identify the contract or contracts with the customer. So the best one I can think of is if we are Telstra and customers come in and sign up for a mobile phone contract. They receive a mobile phone when they walk out and they get access to airtime for, let's say, 24 months. So it's important to identify the contract with the customer. Is it only the contract with the individual walking in? What if the individual walks in, let's say it's me with my husband and my 4 children, would we look at 6 separate contracts, or would we potentially combine those 6 contracts into one contract because it's a related party? Maybe there's some interdependency. Maybe Telstra would say, Aletta, you and your husband pay full price, or maybe pay a little bit more, and we'll give a good deal for the children. So step 1 is identify the contract, identify whether we combine contracts because it's with related parties. So let's get all the contracts on the table. Step 2 is look at the contracts and identify the distinct promises. So what does Telstra promise us when we sign up? They promise that they'll give us a mobile phone and they'll give us airtime for 24 months. So 2 promises, 2 performance obligations. In step 3, so what is the transaction price? Now I've done this recently, I think more or less, give or take a few dollars. If you walk in, transaction price is $100 a month for 24 months. So the total transaction price is $2,400. In step 4, you allocate that transaction price to the 2 performance obligations that we've identified in step 2. So if I look at $2,400, what part of that is for the mobile phone? What part of that is to get access to the airtime? Now let's say I could walk in and I could buy an iPhone 7 for $1,000. And let's assume I could walk in and just sign up for airtime for $1,400. In a perfect world, it nicely adds up to my transaction price of $2,400. So if I allocate the transaction price, I would say $1,000 to the mobile phone, $1,400 to the airtime. So then step 5, finally we discuss when should we recognize the revenue. Now you can either recognize the revenue at a point in time, and that point in time would be when you transfer the promise or fulfill the promise, or you could recognize your revenue over time, and that's over the time that you are providing the service, as an example, or fulfilling the performance obligation or fulfilling the promise. So that's the 2 options, at a point in time or over time. Now in this example, the mobile phone Telstra would give to me when I walk out the store. So they would say, I am fulfilling that promise to give you a mobile phone when you walk out. Therefore, you can recognize revenue at a point in time, at the point that you walk out with the phone. For the airtime, they would recognize the revenue over time because their promise is to make airtime available to me for a period of 24 months, and I would consume that over a period of 24 months, and they will recognize that $1,400 over 24 months. So the steps is identify the contracts, See what are the different promises within the contract, step 2. Then determine the transaction price, allocate the transaction price to the different performance obligations or the different promises. And in step 5, when do we fulfill the performance obligation? When do we perform our promises? And that's when we recognize the revenue. Now, as a not-for-profit entity, listening to this, you might say, I would love to be in AASB 15 because I would like to recognize my income as I fulfill my promises. Now, it's not as easy. You can't voluntarily elect to apply AASB 15. So a big question for not-for-profit entities, so when would AASB 15 apply to me, or when would I have to recognize my revenue to line up with my promises? Big question. So to answer this question, a little bit of a decision tree, and the decision tree illustrates 2 hurdles. The first hurdle is, does the transaction occur in a contract with a customer? So putting it differently, does the transaction occur in an agreement with another party that creates enforceable rights and obligations? So 3 key things in there. I need a contract, I need a customer, and enforceable rights and obligations. If I say yes to that, I've got another hurdle to jump. Does the contract include sufficiently specific performance obligations? So does that contract include sufficiently specific promises? And if I say yes to that, I can apply AASB 15. So 2 very steep hurdles that you have to jump before you can apply AASB 15. If you say no to either of those, you're AASB 1058. Now, I want to focus a little bit on, so what is the meaning of contract in a not-for-profit industry? And what, or for this standard, what's the meaning of customer? What's the meaning of enforceable rights? What's the meaning of sufficiently specific? The amendments or the Australian application guidance discuss this and give us examples on this is definitely sufficiently specific, this is definitely not sufficiently specific, and there's a number of things that's in a grey area we need judgment. So it's impossible to remove judgment completely. Judgment will be required. However, there is a lot of guidance that we should consider. So if you think a customer or look at a customer is not only if a government come to you and say, here's a government grant, use this money and provide food to the homeless. A lot of people currently argue that the government is maybe not a customer because we're not providing our promises or our food to the government. So this standard says, hang on, in a not-for-profit sector, you often find a situation where the government would give you money and ask you to do certain things on their behalf and to provide food to the homeless, so to provide food to third parties or the community at large. And in that situation, the government within a not-for-profit sector would still be the customer. So very important they clarify this. Your customer could be that party that's making a donation and is directing you to do something, not to them, but to somebody else. So that clarifies that. The second thing is a contract. Now, for a contract to exist, we need enforceable rights and obligations. Often we need a legal view. Do we have enforceable rights and obligations? At BDO, we have an internal or in-house legal counsel who often help me to look at these contracts. So if we look at enforceable rights and obligations, it would be enforceable either through legal means, but then they also introduce the concept it could be enforceable through equivalent means. So what are examples of legal or equivalent means that would lead to enforceable rights and obligations? I've got a few examples here. The first one If you are not doing as instructed, so we give you a government grant and you do not provide food to the homeless, a refund is required. You have to come back and say, here's the money because I haven't done as you've asked me or instructed me to do. So a refund could be an indicator, or it could result in enforceable agreements and would. The second one is the customer or another party acting on its behalf has a right to the specific performance, or they can claim damages. So you're not doing the right thing, you don't have to refund, they can claim damage from you. That would lead to enforceable rights and obligations. Or the customer has the right to take a financial interest in an asset that they've contributed. So sometimes the government or another party could give you an asset or give you money to build an asset, and they would say, we would like you to use this building to provide shelter for the homeless. And if you don't do that, they could take back ownership of that building. That is also an enforceable right and obligation. The parties to the agreement, if the parties to the agreement are required to agree on alternative application of the resources that they've provided, that's also an enforceable right and obligation, because a not-for-profit entity cannot just decide, you've given me money to provide food to the homes. However, you know what I'm going to do? I'm going to take this money and I'm going to build houses for the homeless. So it's not food anymore, it's now houses. If you can only do that after you've agreed it with the provider of the funding, then it's an enforceable right and obligation. Again, you can't just unilaterally make that decision. And sometimes within the public sector, there could be an administrative process that exists to enforce enforceability of these grants. The other thing is, sometimes as a consequence of failing to do what you've promised to do, you sometimes have to return the money, or there could be a penalty, and that penalty could be so severe that you will definitely do it. It's a really compelling penalty. Again, that will lead to enforceable rights and obligations. A very important point is the last bullet point on this slide, and that is that enforceability depends solely on the customer's capacity to enforce its right. So we do not look at past experience and say, listen, yes, they've got the capacity to enforce these rights, they've got the capacity to ask for a refund, however, they've never done it. So we don't look at past experience here. Here we look at, according to the legal agreement, according to the funding arrangements, do the customer have the capability or the capacity to enforce its rights? That's all we look at. So this is all still about that first hurdle that we want to jump. Now the following is trying to say, let's make it very clear that the following circumstances would not on their own cause an agreement to be enforceable. So one, if, let's say, the government have provided money to you, if they can say, here's money for this year, if you don't do what we've asked you to do, we will not give you future funding for years 2, 3, 4. Now in that situation, it's not an enforceable right and obligation. You receive the money for year 1, doesn't matter what you do with it, you keep it. To withholding future funding, therefore, does not lead to enforceable rights and obligations, generally on its own. Also, if a not-for-profit entity publishes a statement of intent to spend their money in a certain way, that's not enforceable right and obligation. That's a statement of intent. On our website, this is what we intend or plan to do. Again, it's not an enforceable right and obligation that somebody else can enforce. That's just our intention. The other thing to consider is commercial substance. Now, in the for-profit world, you only have a contract and you can only apply AASB 15 if the transaction has commercial substance. For example, contracts provide goods or services to members of the community on a subsidized basis on a cost recovery basis, we might say, commercially for a not-for-profit entity, that doesn't make sense. So in this Australian application guidance for not-for-profit entities, they specifically say we don't focus on that. The commercial substance is that we are achieving our outcomes, we are improving society, or there's social benefits involved. So that's very important. The second hurdle that we would like to jump is sufficiently specific performance obligations, and this is a critical one. And they give us a number of examples of which performance obligations or which promises which are included in funding arrangements would be sufficiently specific for you to apply AASB 15. So first of all, they say the following are examples that would generally not create a performance obligation because it's not sufficiently specific. So a not-for-profit entity making a statement of intent to transfer something, no, that's not good enough, that's not sufficiently specific. Or a condition that a not-for-profit entity must transfer unspecified goods or services within a period of time. So there's a condition within our funding arrangement. Here's the money. We would like you to provide counselling services to abused women and children, and we would like you to provide those services for the next year. That's not specific enough. To add a time period is not specific enough. To say that you have to provide counselling services for a period of 3 years is not sufficiently specific. If you have a single-purpose charter, say all we do is provide counselling services, again, it's not specific enough. The following, they say, may be specific enough. Judgment is required. We have to look at it carefully. So with this one, an agreement may include a condition that the entity undertakes an acquittal process to demonstrate progress towards transferring your goods or services. So you have to do certain things, and we want to put an acquittal process in place to make sure that you do that. So an acquittal process does not automatically lead to sufficiently specific performance obligations, but it could get you there. So such an acquittal process may provide the evidence depending on the other facts and circumstances. And a big thing for an acquittal process, it actually helps you to measure or to determine the progress. So first of all, you need sufficiently specific performance obligations, so very clear promises. And in these promises, we need the ability to measure whether you've actually done it or not. And that's when an acquittal process could become very handy. Then another situation, they say, where a contract provides a transfer of a financial asset to a not-for-profit entity, so a financial asset, cash, to a not-for-profit entity, and what you have to do with it is you either have to build a new building or you have to buy a building, and that new building will not be controlled by the person providing the funding, will actually be controlled by the not-for-profit entity. Now, in that situation, there are no promises for you to do certain things in return to the person, the customer, and therefore the contract is not a contract with the customer. It's not within AASB 15, and we look at AASB 1058. It's because there are no sufficiently specific performance obligations. We want you to take the money, we want you to buy a building, we want you to provide housing to the homeless for the next 10 years. Not specific enough. So it's very important to assess whether your promises, your performance obligations are sufficiently specific. So I thought, based on that, I need a glass of water or a sip of water. Maybe I'll ask you a question. So the question that I want to ask you, and now I've confused myself, how do you like that? Aletta, what are you doing? Please bear with me. I am a problem here. I want to ask you the question, do you think your current funding arrangements would provide sufficiently specific performance obligations? Yes, no, or unsure. I would absolutely understand if a lot of you think I'm unsure, and we'll have to look at the guidance and the standard a little bit more. But just roughly, do you think you've got those sufficiently specific performance obligations? Thank you very much for participating. It's quite amazing that people are willing to share, willing to communicate with us. For me, it's really fascinating. When I prepare these poll questions, I think I know the answer, and then I'm often surprised by the answer, often surprised. So if everybody could participate, now if you're not a not-for-profit entity, but maybe you've got not-for-profit clients, maybe think about your biggest not-for-profit client. Do you think they've got sufficiently specific performance obligations, yes or no? I'll give it another 10 seconds and then we'll see if we can analyze the results and what our participants are telling us. Fantastic. All right. So in this situation, we have seen that 41% of you do believe that you've got sufficiently specific performance obligations, which would be fantastic, because that would get you into the new AASB 15. You will have to become very familiar with the requirements of AASB 15, but that is a good start. 90% says no. It would be interesting whether you've got any ability to negotiate, to potentially include specific performance obligations, whether you want that or not, whether you're happy with your current environment. And 40% unsure. Very interesting. 40% unsure, and that's actually what I've more expected. I've expected, we're not sure, we'll have to go back. We've got a lot of different funding arrangements. We'll have to put our funding arrangements together. We'll have to group them together and then analyze and do an analysis of whether we think it's sufficiently specific or not. So very interesting, and I would like to say thank you for participating. And I'll ask you some interesting questions a little bit later as well. So when does AASB 1058 apply to not-for-profit entities? So it comes back to the same decision tree. If you say, I don't have a contract with a customer, I don't have enforceable rights and obligations. So what has happened? As my slides disappeared. Let me just have a quick look. I don't think I should be there. I think you should be seeing my slides. Is that better? Fantastic. Thank you very much, Sarah. So you should be seeing my slides, and I should be very small on your screen, please. If not, you have to send me a message, Aletta, I don't want to look at you. We want to look at your slides. So we're back to the very same decision tree. And this decision tree says, if I don't have a contract with the customer, and if that contract doesn't create enforceable rights and obligations, then I'm in 1058. Or if I don't have sufficiently specific performance obligations, I'm in 1058. There's a few other interesting things in 1058 as well. So it's not only about the decision tree, there's also new requirements around volunteer services, and there's also requirements around what I would call peppercorn leases. The specific words are transactions where the consideration to acquire an asset, could be any asset, but a peppercorn lease is a good example. So what you pay to acquire an asset or the right to use an asset is significantly less than the fair value. And the reason somebody is saying, here's an asset without paying for it, or you can use a property for $1 a year for the next 30 years, is they want to further your objectives. They want to support you as a not-for-profit. So in that situation, we also apply AASB 1058. So 3 ways really into AASB 1058. So if you are in AASB 1058, what are the requirements? Now, the first thing I want to talk about is volunteer services. Now, if you're a not-for-profit, private sector entity, you've got an accounting policy choice. Public sector, they don't have a choice. They have to fair value volunteer services. So I'm going to focus on not-for-profit private sector entities because that's most of the entities we've expected to join our webinar today. If you're in the public sector, please contact me. So the first question is, can the fair value of the volunteer services be measured reliably? So if you say no, no worries, volunteer services would not be recognized. However, as you know, these days as part of accounting, we have to measure and make estimates of a number of things, including fair value of volunteer services. And if you say, yes, we can actually do it, does the entity elect to recognize volunteer services in its financial statements? So you've got an accounting policy choice to make that you'll have to disclose in your financial statements. If you say no, we don't disclose it, easy, we don't do it, just disclose your policy. Or if you say yes, what do? We determine the fair value of these volunteer services. We include it as income, potentially. We expense it as it's incurred, and the impact on your profit before tax really, no impact on profit before tax. So you'll recognize your volunteer service at fair value. Usually volunteer services would not lead to an asset, usually it leads to an expense. So you'll expense it, and if there's an excess between the fair value of the service, so the fair value of the service is $100,000, so we have revenue or income of $100,000, we also have an expense of $100,000, impact on profit is still zero. But now users, when they look at your financial statements, they know what funding you would require if you didn't have volunteers in your organization. So I know I spoke to a client fairly recently in the last week where they said they provide training to medical professionals, and they have qualified, very experienced medical professionals volunteer their time to provide training and provide advice to trainee doctors in specialist areas especially. And those volunteer services, we can measure their fair value. We know what the charge-out rate of a medical specialist is. So they come in and they provide those training services free of charge. Therefore, there's a big issue. If we don't have those experienced professionals volunteering their time, that organization would really need to raise a lot of additional funds. So there's very useful information to fair value of volunteer services. However, it's an accounting policy choice. And I think a lot of not-for-profit entities would say it's really a burden on us to try and determine that fair value, especially if it's difficult. Also, I don't want to pay a valuer to come and do this valuation for me because I instead want to use that money for the cause, to provide food, to provide shelter, to provide counseling. So I think that's quite important. The other thing is, so that's volunteer services. Just going back to volunteer services, I thought I might get your view on that and might ask you, another question. And that is, if you use volunteers in your not-for-profit organization, would you prefer to account for those volunteer services? Yes or no, or you're not sure? I must admit, while you are voting, as an immigrant to this wonderful country, I'm extremely impressed how in Australian society volunteers participate. whether it's working with the elderly, whether it's working with young children, whether it's reading programs at school, whether it's taking, disabled children on day trips. Absolutely amazing, the things you see here. Absolutely amazing. One of the best things of Australia, in my view, a real culture of volunteers doing things. Very interesting. Most people have voted, or many people have voted, so let's look at the results. 39% of you said that you would be happy to include and disclose volunteer services in your financial statements. 40% no, so it's really very even between the yes and the no. And 21% thinks, listen, I think we have to think about this a bit more, the time, the effort, maybe do a cost-benefit analysis before we decide. But I think it's something to at least consider and take back to your boards, whether they want to go down that route. But as a minimum, you'll have to disclose your accounting policy choice going forward. So again, I'm hoping you can see my slides now. Is that right? Everybody ready? So let's go on. So let's look at what if we've got transactions other than volunteer services. We're in AASB 1058. We couldn't apply AASB 15. It's not volunteer services. How do we apply the standard? Now, I've put it down to 3 steps. Step 1 is when you receive an asset or cash, cash, a vehicle, a building, whatever you receive, whether you receive it through a grant, a donation, doesn't matter. When you receive that asset, you would apply the requirements of the Australian accounting standards, all of them, to determine how to account for it. So what do I mean by that? If I receive cash, I'll apply AASB 139 financial instruments, and usually I would say debit cash. If I've received property, plant and equipment, I would say debit property, plant and equipment. If I've received an intangible asset, I would debit an intangible asset. So when we receive that asset, we'll look at these other Australian accounting standards and we'll come up with what do those standards tell us? How should we recognize and measure the asset? Now, these other accounting standards would usually tell you that you account for property, plant and equipment, let's say, at cost. So you look at those standards and you do what they tell you to do. Then in step 2, on initial recognition of that asset, you think, what do I have to credit here? And you go through a process. Is it a contribution by an owner, perhaps? So if an owner of the entity gives me an asset, I would say debit asset, credit capital contributed. Maybe they give me an asset, but I also now owe them money for the asset. I have to pay them over the next number of years. So maybe I credit a liability. I'm thinking about a lease, for an example. You would say under the new AASB 16, debit an asset, the right of use asset, and credit a lease liability. So maybe that's what I do, and I'll do that. Maybe there's a decrease in an asset, so maybe I've paid something. So I've got an asset, maybe I've paid something for that asset, so I decrease my asset. I might not have paid what it's worth, but I've paid something. Maybe I've got sufficiently specific performance obligations and I'm applying AASB 15 for the credit side. So let's say if there's sufficiently specific performance obligations, I'm going to say debit the cash, and I'm going to say credit a refund obligation because I don't do what I have to do. I have to repay this money. So that's also an alternative. So after you've gone through I debit cash, and after you've gone through what could I logically credit in terms of all these other standards, step 3 is you recognize immediately in profit or loss the difference or the excess, the extent to which your asset in step 1 exceeds whatever amount you could recognize in step 2. So we're not saying debit cash and automatically immediately credit income. There's a step 2 which says debit cash, step 1. Step 2, think about this. Is a contribution by an owner? Do we have performance obligations? Do we have to credit a refund obligation in terms of AASB 15? Should we increase a lease liability? Consider all of those other Australian accounting standards, and only if none of them are applicable or appropriate, then you get to step 3 to recognize immediately in profit or loss the excess of step 1 over step 2. Now, I think it's important to look at a few examples to illustrate this. Now, first of all, I'm looking at example 2 from AASB 1058. So let's say a charity makes a contribution of $500,000 to establish Company S, and Company S operates childcare centres. So there are no repayment terms to the contribution, and there are no goods or services to be provided to charity B in return. Now, Company S is a company limited by guarantee. Their member contribution that's required is only $10. We've done an analysis and we are happy that Charity B controls the voting rights in Company S. So in that situation, the related amount of the cash asset that we've received is actually a contribution by the owner. Step 1 is to say debit cash when Company S received the money, debit cash $500,000, and credit equity, credit contributed capital, because one of the owners, Charity B, have given me this money. And if an owner gives me money, it's contributed capital. If an owner gives me money, it cannot be income or revenue. So that's example 2. The other thing, before we look at a further example that I want to specifically flag, is peppercorn leases. And as you know, there's a new AASB 16 on leases, and we've done a webinar on that last week. So if you want to investigate that a bit more, please do so. The recording is on our website, or you can contact me and I can send you a link. Now, if you're a lessee, you not-for-profit entity, leases a property at a significantly below rent amount of money, and the reason the other party is doing that is because they would like you to continue to do your good work, then the not-for-profit entity shall do the following. So it's not an accounting policy choice. This is, you shall do the following. Number 1, you have to measure that right of use asset at fair value. Remember, the new AASB 16 says they don't, AASB 16 does not differentiate between finance leases and operating leases. If you're leasing a building, a property, anything you lease, you're going to say debit a right of use asset on day 1, and you're going to credit a liability on day 1. If you are a not-for-profit entity, if you've done the calculations in terms of AASB 16, if you are paying $1 a year for the next 30 years, you would have said, just by applying AASB 16, you would have said debit an asset, let's say $30, credit a liability $30. But now this standard says, hang on, we're going to amend AASB 16 for not-for-profit entities and say not-for-profit entities, you don't debit the asset with just the $30. You debit that asset on day 1 of the fair value of that right to use the asset for 30 years. So what is the fair value of that right to use that building, that property for 30 years? That is your step 1 amount. Debit the asset, let's say 30 million. Then in step 2, you're going to measure the lease liability at the present value of whatever you have to pay. So what do you have to pay in future? Let's say $30. I'm not doing net present value for my example. And I'm saying I credit a liability of $30. So I've got an asset 30 million, I've got a liability $30. What do I do with the difference? On day 1, I then have to look at AASB 1058 and consider where does that credit go? If this lease is with an owner, then, as in our previous example, it could go to a contribution by an owner. But often it's an unrelated party that would like to further your objectives, and often it's an immediate profit and loss impact, immediate income in statement of profit and loss and other comprehensive income. The other option to consider is, are there sufficiently specific performance obligations? Because then the credit could go to a refund liability, and potentially we would decrease the refund liability and increase our income as we perform. So that's with the AASB 15. But peppercorn leases is a huge change under these amending standards and something to be analysed. So again, I thought let's just do a little bit of a poll on peppercorn leases because I've got a view, but I would like to check that with you. So first of all, do your organization have any peppercorn leases? I want to know, how prevalent is this within our client base? So please vote. As I speak about standard at many events, there's always people who come to me afterwards and say, Aletta, we've got peppercorn leases, we've got a lot of peppercorn leases, this is a disaster, how do we determine the fair value? It's going to have a big impact on us. I want to try and assess how many of you actually have peppercorn leases. That would be very interesting. I'll give you another 10 seconds if you want to vote. Let me know whether you've got them or not. Fantastic. I'll share with you. So 36% of those attendees today would say that they've got peppercorn leases. So it's an automatic impact. This stands definitely, you'll have to consider very carefully. And you actually have to consider very carefully the requirements of AASB 16 as well as the requirements of AASB 1058, because the two together will disclose how, or will, unpack how this will impact your organization. So last week we had a webinar on AASB 16, very high level, but there's also another few scheduled during the year. If you're interested in that, or please contact me, because peppercorn leases, absolutely, there would be an impact. All right. So if we go on to our next example, example 6A. All right. So in this example, it's an example from AASB 1058. It says Charity B receives a government grant of 2.4 million on the 31st of May, year 6. It is refundable if the money is not spent in the period 1 July 26 to 30 June 27. So Charity B's agreement with the grantor specify that this grant must be used in accordance with the charity's overall objectives. The agreement does not specify the exact services that the grant must be used for. So looking at that, we are saying you get your government grant. Number one, debit cash the 2.4 million. You do not, what do we credit? It's not a contribution by an owner. You don't owe anybody any money, so there's no liability. There's no sufficiently specific performance obligations in terms of AASB 15, and therefore you would immediately have to credit income 2.4 million. So this would happen when you get the cash, which is in 31 May, year 6. Although you'll only use the cash to perform your wonderful services over the next financial year. So in that situation, your big problem is the fact that you don't have sufficiently specific performance obligations. They extend on that and say, what if Charity B receives the money on 31st of May? Again, it's refundable if it's not spent within a certain 12-month period. And Charity B's charter states its purpose is to provide counselling to victims of violence and emergency accommodation to the homeless. And Charity B has an agreement with the grantor that specifies that the grant must be spent providing crisis counselling services for a certain number of hours per week for the entire year ending 30 June. Charity B expects to fulfill its promise to provide the counselling services. So here you can see we get money, we've got 12 months to spend it, otherwise we have to repay it, so it's enforceable. And also there's clear, sufficiently specific performance obligations because I have to do a specific number of hours per week and we can measure whether we've done that or not. Therefore, in this situation, we will say debit cash, the 2.4 million. We would say credit a contract liability in terms of AASB 15 for 2.4 million. And as we now deliver on our promises, and as we meet those promises, we would say debit our contract liability and credit income. In another example, example 7a, the charity's publicly stated objective is to build water wells to provide clean drinking water in developing countries. And donations, the donors indicated that the donation should be used for building water wells. In this one, they've got a telethon, something similar to what we have in Melbourne. On Easter Friday, the Royal Melbourne Children's Hospital do a telethon and a fundraising big event every year. And we've received 200 donations of $800 each, or we received pledges on the Friday. How do we account for that? Because it's only a pledge and it's not legally enforceable. In that situation, we would not recognize an asset, and also there would not be a liability. You only consider the recognition of that pledge when you actually receive the money. So that's dealing with telethons. Looking at that example slightly more, maybe Charity C's publicly stated objective is still to build these water wells. In this example, we now receive the actual cash to do that. The board have determined at a board meeting that they're going to use the money to build water wells in Kenya, but board has not publicly communicated that. And for the question is, if they've not publicly communicated that, is it legally enforceable? So only the board knows about it. People are giving us donations. Do they have the right to enforce that? Is there legal enforceability involved? And in this situation, one would argue because only the board knows, there's no stated intention made to the customers or the donors. When you receive the money, you would say debit cash and credit income. Is not legally enforceable and also not really sufficiently specific performance obligations. You could do voluntary disclosure of the restrictions and say, listen, we've received this money, we will only use this money to build water wells in Kenya as decided at a board meeting, and it's voluntary whether you want to disclose that or not. Continuing on that example, what if again, we received donation, but now if we look at the last two bullet points, Charity C collect donations as part of a campaign to raise funds for building water wells in Kenya. However, Charity C indicated that any funds not required would be spent on other purposes in Kenya. So when you give money, yes, we want to build water wells, but sometimes we could do other things as well. Subsequently, they decide that we're not going to build water wells because there's been a disease outbreak and we're actually going to spend the money for emergency food and medical supplies. So in that situation, your criteria would be debit, your journal would be debit, cash, credit, income. Because the entity could decide whether they want to build water wells or do other things. There's no sufficiently specific performance obligations. So again, debit, cash, credit, income. In the last part of the example, they say, all right, we've received the donations and we've said to the donors we're going to use it to build water wells, but we've also gone further. We've said to them how many water wells we're going to build. We've told them what it's going to cost us. very specific what we're going to do with the money. To me, it reminds me a little bit of what my children do at our church. You know, they take money to Sunday school on a Sunday, and they use the money, they put it together, and they go in one of the well-known not-for-profit organizations. They take that money and they buy a goat for a community, a disadvantaged community, and that community will then have milk. So in that situation, when the children donate their money, they know exactly what they're getting. There's a sufficiently specific performance obligation. So in our example, because we're saying exactly what we're going to do, when we're going to do it, how much it's going to cost us, you will initially say debit, cash, credit or contract liability, and then once you've built the well, you'll say debit the contract liability and now credit income. Please don't worry about the $153,000. If you read the whole lengthy example in the standard, it says that's what the construction of the wells would cost. So obviously, as you spend the money, you create that expense. So this is an example where there's sufficiently specific performance obligations. So today, I've just wanted to start the conversation. I mean, these new standards for not-for-profit entities and recognizing income by not-for-profit entities are really brand new. It's been issued in 20th of December, so just over 2 months ago. We have a little bit of time to have a discussion, to have analysis on how this works. I'm looking for practical examples. I would love for you to say, help us with contracts. Let's have a look at them. How do you think we'll have to recognize revenue going forward? Peppercorn leases, I think we have to talk about it. So this is just starting conversation. We've looked at the new AASB 15 very briefly. I have to say very briefly. We said when would AASB 15 apply to not-for-profit entities, so legally enforceable contracts and sufficiently specific performance obligations. When would 1058 apply, volunteer services, or when you receive something and you've not really paid an equal amount, or what you've paid is less than the fair value. And also, what are the requirements of 1058? And we've looked at a number of examples. Now, all these standards include a number of examples that you could look at, and it's available on the AASB website. We also do regular newsletters, videos, webinars that you can find there. Any questions, please email me those questions or put it in the question bar. I would like to say thank you very much for joining me today. It's 4 minutes past 12, so I've gone 4 minutes over time. I do apologize for that. I'll try and stick to 60 minutes. I'll try my best. I'll have to speak faster. Or I'll have to delete a few slides, whatever. I'll do my best. I hope to see you next month. I think our next one is on 15th of March, where we talk about financial instruments. So thank you very much for joining me. I'll speak to you soon.